Passive investing. You've heard of it. You probably even do it. It has completely revolutionized finance over the last few decades. I mean, millions of us now have a slice of the market through these super low-cost ETFs and index funds. It's easy, it's cheap, it's changed the whole game. But what if this massive world-changing shift has a hidden dark side? Okay, let's get into it. So just take a look at this chart. This shows you the absolutely explosive growth of passive investing, specifically through ETFs. We're talking about a climb from pretty much zero to, on average, more than 10% of a company's stock just being held by these passive funds. Now, this wave has made investing way more accessible for everyone, which is great. But as that tide gets higher and higher, it's starting to raise some really serious questions about the very foundation of our markets. And look, it's not just a few academics in an ivory tower asking these questions. This quote, this is from the U.S. Securities and Exchange Commission, the SEC. When the top market regulator comes out and says they're concerned about the overall quality of financial markets, you just know something pretty significant is going on under the hood. And that's really the core tension we're going to dig into today. So we know the benefits of passive investing are massive. No one's denying that. But could it be a double-edged sword? We're going to dive into some new research that looks at the potential risks that might be hiding behind all this convenience. And this is the million-dollar question that a new paper from the American Economic Association really wanted to answer. They looked past the popular view of passive investing as this simple, safe, almost boring choice, and they asked, what if this huge, unstoppable flow of what you might call unthinking money is actually making the entire system more fragile, more brittle? Okay, so how in the world do you even measure something as vague as market fragility? Well, the researchers started by looking for cracks in the system. You know, the little telltale signs that things aren't quite as solid as they look on the surface. And what they found is pretty eye-opening. First up, they looked at this concept called return reversal. Now, in a really healthy liquid market, prices should be relatively stable. But if a stock suddenly shoots up one week for no good reason, only to come crashing back down the next, that's a return reversal. A good way to think about it is like having clogged plumbing in the market. These strong whiplash-like reversals suggest there just aren't enough buyers and sellers ready to trade smoothly, and that causes these really violent price swings. And this is where the story gets really visual. Look at these two charts. The blue line, that's stocks with low passive ownership. You see a few little wiggles, but it's basically stable, right? Now look at the red line. Those are the stocks with high passive ownership. And this just perfectly illustrates the problem. After a price spike, they don't just dip, they plummet and they stay down. We're talking a drop of 1% almost immediately, and it gets as bad as 2% over 2 years. The reversal is way stronger, it's faster, and it just sticks around. And it wasn't just those reversals. The researchers found a whole bunch of other red flags pointing to lower market quality. Things like higher bid-ask spreads, which is basically the fee you pay to trade. A wider spread just means it's more expensive for you to buy or sell. They also found these stocks are way more vulnerable to market-wide liquidity shocks, meaning when the whole market starts to panic, these get hit the hardest. And finally, more idiosyncratic volatility, which is just a fancy way of saying wild, unpredictable price swings that have absolutely nothing to do with how the company's actually doing. And put a really scary number on all this, the researchers calculated the impact on what's called tail risk. That's the danger of a sudden, catastrophic, out-of-nowhere price crash. What they found was that a standard increase in passive ownership causes a staggering 19.2% increase in this risk. That is a huge jump in the odds of a flash crash for any given stock. Okay, so we've seen the what, the evidence that markets are getting a bit shakier. But the really crucial question is, why? What's the actual mechanism here? What's going on behind the scenes? To get to the bottom of it, we have to understand the difference between news and noise. The best analogy is a radio. News is the clear signal. It's real, fundamental information. A company announces record profits? That's news. Noise, on the other hand, is all the static that drowns that signal out. It's price movement caused by things that have nothing to do with the company's actual value. For instance, a giant S&P 500 index fund has to buy a stock, not because the company is great, but simply because it's in the index. That huge buying pressure, that's noise. And here, my friends, is the punchline of the entire study. The researchers found a direct causal link. As passive ownership goes up, the importance of all that random noise in a stock's price goes way, way up. And at the exact same time, the importance of actual company-specific news goes down. In other words, the static is getting louder and the actual music is fading away. And the numbers here are pretty striking. A typical rise in passive ownership cranks up the volume on noise by about 6 percentage points. But even more worrying, it dials down the importance of real company information by 9 percentage points. The bottom line here is that stock prices are becoming less and less connected to economic reality. So how does this actually happen? Well, it looks like it creates a kind of dangerous feedback loop, a vicious cycle, really. It starts when passive funds buy or sell a stock just because an index tells them to. That creates price moves that have nothing to do with the company's health. That's the noise. Now, imagine you're an active investor. You've done your homework, you found some great news about that company, and you want to buy its stock. But you see the price getting thrown around by these giant, indiscriminate passive flows. It makes your job way harder and a lot riskier. So maybe you don't invest or you invest less. And as more smart investors like you pull back, the noise just gets louder and the stock's price drifts further and further from its true value. Okay, so this is all fascinating stuff if you're a finance nerd, but why does it really matter to you, to me, to the economy as a whole? Let's zoom out and look at the big picture. The potential real-world consequences are actually huge. See, a healthy market is supposed to be a discovery engine. It's meant to find the best, most innovative companies and direct our collective savings to them. But if stock prices are just being driven by how big a company is, capital might not be flowing to the best ideas. Imagine a brilliant little startup struggling for cash, while a mediocre giant gets flooded with investment just because it's in the S&P 500. And for all of us, lower liquidity means that when a real crisis hits, that sell button might not work quite as smoothly as you'd hope, which could make a panic so much worse. So, at the end of the day, we're left with this really provocative question. Passive investing has made it easier and cheaper for millions of people to build wealth. That is an undeniable, incredible good. But as it continues its march toward total domination of the market, are we accidentally making a trade? Are we accepting the amazing convenience of today in exchange for a more fragile, less efficient, and frankly, riskier market tomorrow? This research suggests that's a question we really need to start taking seriously.